Chief Financial Officer, which will be in charge of finance and books and everything. Chief Legal Officer, which would be like corporate counsel or general counsel. Chief Operations Officer, in charge of operations. Chief Technology Officer, CTO, whatever you want, right? The structure of the board of directors and the officers will all be detailed in the bylaws of the corporation. The bylaws are the constitution of a corporation. The bylaws are going to spell out, and they're required by law in order to establish a corporation. The bylaws are the organizational document of a corporation that will detail how the corporation is structured in terms of the officers, when meetings will occur, how the meetings have to be announced, like publicly, what sort of advance notice you have to provide in order to have a meeting to make sure it's legal, who will be entitled to vote at the meeting, different layers of officers. So back to this, you may have layer 1, and then down below that, where you get the president, vice president, secretary, and treasurer. So you may have different levels. Most small businesses don't have those officers. Typically, you have president, secretary, treasurer, maybe a vice president. Now, you can come up with whatever officers you want. You have to have those as a minimum. The president and the secretary have to be in public record, registered with the Secretary of State. That's something you can look up on the Secretary of State's website. We did that with Nike last time, if I remember. So those are the two officers that have to be put out there in the public. If you're a private company, you don't otherwise have to put notice out there on who your officers are, but those two you do have to do. All right, so this dual level structure, it's not super common in a small business. In a large business, very common. And again, you can have whatever officers you want. I had a client, it was a family run business, and they had 17 different vice presidents. So they had like vice president in charge of engineering, vice president in charge of research and development, vice president in charge of finance, vice president in charge of marketing. And the reason why they did that, there were a couple reasons. Number one, they all wanted to have business cards. These are all family members, right? Cousins and uncles and brothers and sisters and parents and grandparents. So they all wanted to have cool little business cards that had this cool name on there. So they came up with all these different names, and that was all spelled out in their bylaws. They were custom made. I didn't actually write them, previous lawyer did. So they had all these different vice presidents. Now they really didn't do much, but it was a marketing thing, so they could go hand out business cards. Or it may be, and this is part of why they also did that, so when they had their board meetings, at Wharton Steakhouse in downtown Portland, which is the fancy restaurant, they'd go rent out and they'd have a board meeting, which is basically a family gathering. So then they would deduct it. So you can get creative here. One of the disadvantages to getting all sorts of different officers is, especially in family business, conflicts. So you have the chief technology officer and you have the chief software officer, I don't know, and they disagree with each other, and it's not well defined who has the authority to do certain things, and that can lead to management dysfunction and disputes. And that's, again, why you always want to have someone at the top that would have ultimate decision-making authority. I have another client of mine, again, a family-run business, and when they first started out, they did not have these officers. And as they grew over the generations, they're now, I think, in their 4th generation, they now have, I don't know, about 2,500, 3,000 employees, multiple family members that are involved. And so the great-grandfather started it, grandfather's children then inherited it, so you had the grandkids. The grandkids eventually, all but one, got bought out. And so we had one left who ran the business for about 40 years, and then that person wanted to retire, and they wanted the next generation to take over. When they did that, they brought in a lot of non-family members to be chief financial officer, so they had a CPA come in who was not a family member whatsoever. So they created this new level of officers to be able to fulfill those roles. And then so basically the parent was the CEO, who really didn't, he stepped back, but ultimately had final decision-making authority on everything. They could veto anything. And then you had the lower level, which ended up being, this was the son-in-law, the daughter, the son, and then they had a couple different vice presidents. So the idea was that the dad wanted to step down, but he still wanted to have some control until they really got up and going good, at which point full retirement. So they created these different levels of officers. Now that can all be done, you got to spell it out in the bylaws. That's the point I'm making. You can get creative, but you also have to be kind of careful so you don't run into this overlap of authority. And that's not always very easy to do in writing. It seems so simple, but it's not easy always to describe when your authority starts and where it ends without there being confusion. Their bylaws were about 100 pages long. I mean, they were pretty thick. Normally bylaws are about 10 pages, so they were very detailed. All right, so the officers are more going to be on the day-to-day type decision making, and then from there you go down to your managers and employees who are, lower level on the decision-making tree. I put here like HR director, those kind of things. So this is the typical structure for a corporation. Again, you can design it however you want, but the ownership level is distinct from the management level. So you may have people on the board of directors, that may not even own shares of stock in the company. Again, you may have an officer that may not have any ownership interest whatsoever in the company. Maybe it's the primary accountant or primary lawyer that does all the work for the company, but they don't actually hold any shares of stock. I'm on a couple of boards myself. I don't have ownership in the companies. I'm paid to be there, paid to be on the board, but I don't have any ownership. So the ownership is distinct from the management. That's the point I'm making. Now, it may be all the same people if it's a small company. In terms of liability protection, there's a shield here. So just like we've talked about before, if there's a lawsuit, that will shield the owners. They're going to lose their investment potentially, but their personal assets are protected. And there's also a shield. It's not as great of a shield that flows this way, meaning decision-making and management, and this again is where it's different from a partnership. Remember, in a partnership, at some level, if you have management authority, you have personal liability. Here, you have management authority, but any claims that flow out of those management decisions are the responsibility of the corporate entity, not necessarily the individual officers or whatever. Now, there are exceptions to that, as we talked about already. If you personally guarantee something, or if you're the one that actually causes the harm, like if you're the CEO and you're driving the company truck and you run over somebody, you're still personally liable, as is the corporation. In addition, if a member of the board of directors or the officers commit a crime or have a decision that's made that leads to a corporate crime, they may have liability, of course, for that. One of the examples I'm thinking of in my own head is like a food manufacturing company, C corporation, and they find out they have a batch of food products that have maybe E. coli or salmonella and should be recalled, but they don't recall it because it's going to cost them a ton of money, and people get sick and die. That has led to individual liability for the board of directors because it was a criminal act by not doing that. And that's under their laws that require that, disclosure and recall of defective products. So it's not an absolute shield. We've talked about that already, but it is a shield in a very high level that will shield against management decisions itself. All right, so let's talk about S Corps versus C Corps now. So I have these out of order. I didn't realize when I wrote this up. I need to go through and redo this, but for right now, I have these arrows here. I'm going to switch, when I redo this chart, I'm going to put S Corps here and C Corps there. Now, let me tell you why. I'm going to leave LLCs over here. Oh, this is not in your handout, sorry. I have this posted on our Canvas page. I forgot to bring it in, but I will photocopy this and bring it in next week. But I do have this in on our Canvas page. So the reason why I'm going to switch these is there's a bit of historical evolution that has occurred with business organizations over time. And again, limited partnerships have been around a long, long time. General partnership, sole proprietor, all three of these are in one form or the other. Every country has them, and they've been around for centuries in one form or the other. So as we go this way, this is where we get into sort of a historical evolution of business organizations. So LLPs are, I don't know, maybe 150 years old in the United States, something like that. So corporations, what we know as a C corporation, a traditional old school corporation. Corporations have been around for centuries as well. They're not just a United States thing. The idea of a corporate juridical entity goes back to Greece and Rome and etc. Again, partially maritime law. A lot of law comes out of maritime law. So the idea of a corporate entity goes back a long ways. C Corp versus S Corp is purely a United States thing. That comes out of our tax code. Subchapter C of the Internal Revenue Code, subchapter S. That's where those letters come from. So from an evolution standpoint, let's go back to the mid-1980s. We did not have S corporations, and we did not have LLCs. S corporations came in around 1986, if I remember, and LLCs in the mid-1990s here in the United States. So before then, we only had 5 forms of organization that you could choose from in business. And that led to problems, primarily in small business and family-run businesses. Because let's say it's a family farm. Let's say you have 4 children that inherited the farm from their parents. They each have a 25% share. So they want to figure out, okay, how are we going to get that farm organized going into the future where everybody, all 4 siblings get a vote and have limited liability. So what were the options for 4 siblings in a family farm? Well, it could be a general partnership. You all get a vote, that's great. What's the problem? Big problem. No liability protection. General partnership, you have unlimited liability. So they all get a vote on the farm, but they all can be sued if something bad happens and lose their house and everything else. So the family could lose everything. They could be a limited partnership, but now the problem is somebody has to be the manager and the others are only investors. So if you have 4 siblings, maybe one's going to be the general manager of the farm and the other 3 will be considered investors and they can't do any management. So that doesn't really work good for a family farm. or restaurant or whatever, right? Can't really be an LLP because that's primarily limited to professional liability. You could be an LLP in a farm, but it's all going to fall under that general liability, like the medical clinic example. So the farm would be like the medical clinic, and the individual actions don't really apply in that case. So that doesn't really work either. So that leaves you with a C Corp. So they could be a C corporation. Each of them would have 25% shares of stock in the company. They all get a vote. They're all going to be on the board of directors. We're going to have different officers. Great. But now, what's the problem with a C Corp as opposed to these other ones? This line here. Corporate tax. They're going to get double taxed. So this was a real disadvantage to small business and family-run businesses because you couldn't set up a structure where you had limited liability and management authority without having to pay a double tax. All right? Another example, again, prior to S corporations. Let's say you're an individual doctor, dentist, or other professional, artist, doesn't matter. It's just you. You have one option, be a sole proprietor. Problem? No liability protection. Single tax, that's great, but no liability protection. So you're one person. Your other option couldn't be a partnership, got to have more than one. C corporation. So if you're a doctor and you want to have liability protection, or a dentist, or any kind of profession, can't be an LLP, so you got to be a C Corp. Or if you're a farmer, one person, you own the family farm, just you, can either be a sole proprietor or a C Corp. Problem, double tax. One person, but you're still going to have to pay that corporate tax. So again, real problem. So this is where S corporations were formed and created and allowed by federal law and state law, starting in the mid-1980s, coming out of economic recession. And the idea was, let's create a form of a business structure that allows the benefit of limited liability like a C corporation, but the single tax of the other partnership and sole proprietorships. Let's allow a one person to be an S Corp if they want to. That avoids the problem of having to be a sole proprietor, so you can have that limited liability, but not have to pay that corporate tax. And that was the whole point of creating S corporations in the 1980s, was to promote and help family and small business grow, offer a different kind of structure for individuals or family members or small business to set themselves up to have these benefits. So limited liability of a corporation, full management authority but still have liability protection, but single tax of the other type of structures. So that was the whole point of an S Corp. S Corps are still very common. I myself am a big fan of S corporations. They have a lot of advantages to them. They do have some disadvantages. So let's talk about the differences here. And again, I meant to print this out, but I think maybe I have a slide. Okay. Well, we're going to do this, and we'll go to the slides later on. All right. So, again, I will photocopy this and bring a hard copy for you next week. I meant to do it. I have them. They're sitting on my desk. But I do have this posted on our Canvas page. All right, so just in general, the differences between a C Corp and an S Corp. C Corporation is subject to that double tax we talked about last time. that is taxed at the corporate level, and again, when you flow the money as profits out to the owners, they have to declare that on their individual tax returns, so you're getting taxed 2 times. S corporation is a pass-through, like we talked about last time. That is, there's no corporate level tax. All of that money flows down to the shareholders, and then they pay tax on the earnings on their individual level. And of course, tax day is coming up Monday, right? So hopefully you got all your taxes filled out. I filed my extension today, so I'll get around to it by October. But long story short, double tax, single tax. That's the big, big thing, S Corp versus C Corp. Now, it was recognized that, okay, if we create this S corporation's form of structure, we want to put limits on that. We don't want, Microsoft being an S Corp or other huge companies, so they basically no corporate tax would ever be paid. So in order to avoid this problem, we're going to limit the number of shareholders that you can have. So an S corporation is not going to be publicly traded. It's not going to be a big company. When it was first formed, if I remember, they limited to, I think, 25 shareholders. It might have been 10. I don't remember exactly. That doesn't really matter. Now it's 100 maximum shareholders in an S Corp. If you're going to be more shareholders than that, you have to be a C Corp. Just so you know, there is an exception to that, which I've never actually seen in my practice, but I'm sure it does happen. If all of the shareholders are family members, you can technically go above that 100 number. So if you have a multi-generational S corporation, and here's why they have it that way. So let's say we have an S corporation that started in the 1980s, and at that time maybe they had 4 shareholders, and then as generations go on, those 4 shareholders die, and they distribute their shares of stock to their children. And then, so let's say they each have 4 kids, and then, so what's that, 16 kids total, nieces and nephews. And then each of them pass on, let's say they have 2 children each, so now we've got 6, so we have now 32, and then the next generation has, so eventually through generational transfers, you will exceed that 100 shareholders, but because the shares are held by the family, you can go over that. You have to be very careful. And the reason why is this. If you exceed that number, then you lose your S Corp status and you revert back to a C Corp. That is also true if any of the shareholders are not eligible shareholders to be an S Corp. So that's what I have down here. In a C Corp, you can have unlimited number of shareholders and unlimited number of different kinds of stock, which we'll get more to in a moment. In an S Corp, only the shareholders have to be human entities, people. In other words, you cannot have another entity own an S Corp. What do I mean? A C Corp can be owned by another corporation, Microsoft, Intel, etc. It can be owned by a retirement plan, right? Retirement plans consistently invest in publicly traded stock, right? You can have C Corps own C Corps, S Corps can own a C Corp, but a C Corp cannot own an S Corp. Also, if you have limited liability companies or limited partnerships, which is pretty common in family business, you may have a family limited partnership that pools their money to invest in stocks and real estate and rental houses and that kind of thing. Well, that can't own an S Corp stock. So the shareholders have to be a human, or there are ways to do what's called a qualified subchapter S trust, QSST, which is, now we're talking law school, which is a form of a trust that you can have, like, so for example, maybe I had a child that had a disability, like my nephew's autistic, for example. So we have a trust, which is an entity, but it's for the benefit of a human. That can still own under very limited circumstances. So you got to be very careful, because if the shares of stock get transferred to a non-eligible shareholder, like I sold them, I want to sell out, and I sell my shares to another corporation or an LLC, the S corp may lose its status. So you got to be really careful about that. Also, the shareholders must be U.S. citizens or green card holders, with some exceptions to that under DACA. So you've got to be careful about the type of shareholders that you have, or you lose your status. All right, back to C Corps. So a C Corp can have an unlimited number of shareholders, and you can have different kinds of stock. An S Corp can only have one type of stock. Now what do I mean by that? Well, let's talk about that for a minute. Slide on this somewhere. So I printed out, these are PowerPoints that I've been putting, again, this is a new class for me, for those of you that are new. First time I've taught it live. So I've been basically typing this stuff up as we go. So there's a lot of detail in these PowerPoints I hand. I mean, it's like a textbook, really. So a lot of what I'm talking about today are in these slides, but I'm seeing right now they're way too detailed. So hold on for a minute, I gotta find the slide. I don't know them by heart yet, even though I typed them. Okay. So this slide here, this is in your handout. So one of the advantages of a C Corp, which is also different from the S Corp, it's on page 10 of that packet I gave you, well, the slides, probably about page 12, physical pages. All right, so a C corporation, you have the ability to have different classifications of stock. S Corp, you cannot do this. So multiple classifications of stock may have variations such as preferred stock right here. So preferred stock versus common stock. Preferred stock is stock that is ownership in a corporation that, depending on how it's structured, primarily is designed to give an owner of preferred stock either a guaranteed rate of return as a minimum. So in other words, it may say, we at a minimum will guarantee we will pay out 4% every year, or perhaps more depending on market conditions. Where common stock is going to be based upon profitability only, and so there may not be a payout, or the corporation may decide they're not going to pay out any money in dividends. They're going to hold that all back as a retained earning, cash, in the corporation. But with preferred stock, you can force a payout out of that retained earning. And again, this just depends how it's structured. In addition, preferred stock gives you the first right in the event the corporation sells assets, or if it has to dissolve, that is, disincorporate, and they have to sell all the corporate assets. Preferred stock gives you preference over the common stock and getting paid in the event of a dissolution of a corporation. So maybe the corporation is going to shut down for whatever reason, and they're going to sell the land and the buildings and all their assets, and when they pay out that money to the shareholders, the preferred stock shareholders get paid first. And there may not be any money left over to pay the common stock. So that's one type of classification. Can't do that in S Corp. Everybody has the same rights. So other types of stock may be Class A or Class B. You see this, Berkshire Hathaway, Warren Buffett's company does this, where they have Class A share, which is a full share. Class B share is basically 10%, 1/10 of a Class A share. One of the reasons they did that is because the per share price got so high, it really was not affordable, other than if you're an institution, it's like $1 million a share. So Class B or Class A may also have super voting rights, like Class A may have 10-to-1 voting rights over a Class B share. So if you have a Class A share, basically you have more power and authority to vote, board of directors, etc. Or you may have voting or non-voting, so Class A may be voting, Class B may not allow you to vote, or only vote on certain types of things. Or Class A, you can vote on every issue. Class B, well, it just depends how you want to structure it. Or you could have other types of shares, which I talked about voting rights. Did I not put convertible in there? Yeah, here we go. Next slide down. Another type of stock is what's called convertible stock. Convertible stock is a share that you, if you hold it, you have the right, if you want to convert it to a debt instead of ownership, or vice versa. Maybe you loan money to the corporation and you are a part owner, but you want to convert that later on to a debt payment, so you get a guaranteed payment. That's pretty common in startup businesses, especially in technology, where maybe I've got a friend that is back in the 80s, electrical engineer. He was teaching college level calculus when he was a sophomore in high school. I mean, just techno geek genius. I mean, designing stuff way decades before we saw it in the public realm. So he had a whole bunch of patents and all kinds of stuff. He had no money, right? So he went out and formed a company, and he got people to invest money in, and basically what they did is they loaned him the money, which means he's got to pay it back. Problem is, if the company goes bust, you got no money to pay him. They wanted to make sure they're going to get paid back their initial investment, but they also wanted the upside. If he goes big, eventually goes public, they want to be able to convert that loan into shares of stock, because the upside is much greater than, I think it was like a 6% interest rate. So that's where put together convertible stock. So basically they loaned him money, didn't have to make any payments for 10 years, the interest accrued, but then at the end of 10 years they either had to pay it off or refinance it, or the people that loaned the money could say, we're going to convert that loan into 1/3 ownership interest. You guys ever watch Shark Tank? That one? Yeah, they do that a lot on Shark Tank, that kind of thing. So that's called convertible. Again, you can't do that in an S corp. Well, there is one exception, but I won't get into that. So convertible stock, and then I talked about voting shares versus non-voting shares, those kind of things. So these type of variations, this is where a C corp, if you want to have, even if could be an S corporation, but if you want to have some institutional investors, can't be an S corp. So if you're going to look for venture capitalists or that kind of thing, that are LLCs or limited partnerships that may want to invest, that's where you find the venture capitalist pools of money, especially in tech stocks. You're going to have to be a C corp because they just won't be eligible to be an S corp. So there are advantages to the C corp in having these different kinds of classifications of stock. But in the real world, most of the time, most small business, family business, you're not going to have that. There is an exception. So the variations to this in a family business can be good, because if you're going to transition to the next generation, like I talked about earlier, with the multi-generational company where the dad wanted to retain control, well, that could be done through these different classifications of stock. So maybe you come up with a generation 1, Gen 1 level stock that has ultimate voting rights to override lower voting rights. Then you have Gen 2 stock for the next generation that eventually will turn into Gen 1 once Gen 1's gone, or something like that. So you can have these different kinds of shares of stock that will allow the older generation, as they transfer and transition out, to retain the control to be able to override decisions of the next generation. Now this can lead to family tension too, as you can imagine. But there are ways to structure that in a C corp that you can't really do in an S corp. So sometimes, even though you could be an S corp, you want to be a C corp. All right, so where'd my little page go? Sorry to jump around. I'm just, again, I got to get these things organized as I do it. Okay, another advantage over disadvantage with a C corporation, and this is slowly changing, but typically a C corporation, you have better ability to have benefit plans like health insurance plans, FSA plans, and other type of retirement plans, some of which are not going to be available to an S corp, although that's pretty much changing where they're getting to be more or less equal. And then also a fiscal year. This is also changing a little bit, but for the most part, it's still true. An S corp typically has to have a fiscal year be the calendar year, where a C corp can have a fiscal year different than a calendar year. So let me explain what that is. A fiscal year is your accounting year. So we as human entities, we by law have to follow a calendar year. In other words, January 1 through December 31. That's our tax year. A corporation may not want to follow the calendar year for accounting purposes and tax reporting purposes. So for example, school, here at Western and public schools do this. The school year is defined as July 1 through June 30th, rather than January 1 through December 31. The reason why they do it that way is so you can have fall term, winter term, spring term, and summer term all in one accounting year. Whereas if you did by the calendar, you'd have different academic years versus tax reporting and accounting years. That's one reason. Another reason would be in farming and other type of business activities that are cyclical, especially in farming, where you have a crop year. Maybe the crop year, you start planting in May and you harvest in October, but it runs over through the winter. So like here in the valley where we have a lot of grass seed, a lot of farmers do an October 1 to September 30th or a November 1 to October 31 calendar year or fiscal year. That matches the crop year. So you do your planting, so you have all your expense for seed and diesel and fertilizer, and then you have the income from that same crop year, which is the next year after it grows, right? All in the same accounting and tax year. That way you don't have to separate the expenses and the income over two different calendar years, which can be really difficult to do from an accounting standpoint. So C corps have a lot more flexibility in having their own accounting year, that is fiscal year, than an S corp. There are some exceptions to that for an S corp, but for the most part, it has to be the calendar year. And also, the limited liability is more or less the same, at least in theory. Real world, C corps, in some instances, have more limited liability protection than an S corp. The reason why I say that is this has to do with bankruptcy laws and how what C corporations have more options when it comes to a bankruptcy than an S corp does, which is way beyond the scope of this class. But the limited liability is slightly better for a C corp, but it's so technically specific it really, well, I'll tell you where you see that. Cannabis industry. Cannabis is still illegal under federal law, but legal most circumstances under state law. But because of that potential federal illegality, most cannabis operations are going to be a C corp because there are a little bit better liability protections there because of that uncertainty, if you will, between federal and state law. So we still see, the point I'm making is, even though you could be an S corp, you still might want to be a C corp for various reasons. And we'll get into some of those nuances as we work our way through it. Okay, so before I run out of time, let's now talk about LLCs. So just real quick up here, and then we're going to go to my handout. So again, evolution over time. So now we have S Corps post 1986, more or less. But again, there's still an evolution that needs to take place in business organization law, tax law. And this comes down to some of the issues I was just talking about between a C Corp and an S Corp. And that is allowing multiple different kinds of ownership in an entity versus restricting it to a human, having more than 100 potential owners, which you can't do in an S Corp. You can do it in a C Corp, but now you got double tax. So there are still some holes, if you will, or some issues with the way an S Corp is structured that is not perfect. So that's where we get LLCs. LLC stands for Limited Liability Company. Sometimes it's referred to as Limited Liability Corporation, which really isn't technically correct, but commonly said that way. LLCs are the newest form of business structure that we have. They started to appear in the 1990s. And when I say started to appear, each state kind of had to create them on their own, and then eventually they went nationwide. And the idea of an LLC was basically to come up with this form of a business organization structure that you could, kind of like Play-Doh or clay, you could mold it into whatever you want it to be. So basically you could go through and say, all right, we want to have the single tax of an S Corp, but we don't want the problem of only being limited to 100, so we're going to have the ability to have different classifications of types of ownership like a C Corp, but we don't want to have double tax, but we want to have full limited liability, but we want to have a manager like you would in a limited partnership, but we don't want that manager to have liability. So an LLC basically kind of gives you the ability to pick and choose which of these different attributes that I have in these boxes, and then put them all into one entity and call it an LLC. So it's super, super flexible, which is really good, but it's also potentially really bad. So limited liability companies, the basic idea is to form a form of a business organization that has the traits that you want all wrapped up into how you form the LLC. Now this gets a little confusing, but I'll try and break it down and make it simple. So just in general, let's go to my handout. In an LLC, the owners are called members. In a corporation, the owners are shareholders. In a partnership, they are either a limited partner or a general partner. Sole proprietorship, sole proprietor is the owner. LLC, they're called members. I don't know the answer to this actually, if you could change the name to participant or whatever, but by law they're called members in Oregon at least. So again, just like in a corporation or a partnership, you put money in or whatever, and you get a percentage back. It just depends on how it's structured. Okay? And just like everything else with a corporation, you have the full limited liability protection that protects both from claims coming up that arose against the company and also potential cross liability between owners that we talked about last time. So you have that compartmentalization of liability. And this is on that video that I have on Canvas. To start an LLC, you have to file articles of organization with the Secretary of State. Here's the form again. Just like the articles of incorporation, for an LLC, it's articles of organization, where you have to have all the public information that's put on the Secretary of State. And if you don't, then you're not legally organized properly. So pretty straightforward. The bylaws of a LLC are called an operating agreement. These are like bylaws to a corporation. Now, you could also call them bylaws, I suppose. I've never seen it done that way, but an operating agreement is, again, the contract among the members, the owners, and the LLC that organizes. It's the constitutional document that structures how the LLC is going to be formed. It may be very simple, or it may be hundreds of pages long, depending on the complexity. So, next comes management. We'll come back to managing member. So the way I view LLCs is basically an LLC can take the form of one of four traditional organization structures. It could be a sole proprietorship model, a general partnership model, a limited partnership model, or a corporate model. Let me explain what I mean by that. Sole proprietorship model is called a single member LLC. Single member LLC. One person. Very, very common form of business structure now for one person. Do a lot of these in my practice. In fact, I'm going to write one of these up tomorrow for a farmer. And basically the idea of a single member LLC is you have the simplicity like you do with a sole proprietorship. You have to file with the Secretary of State, but that's really all you got to do. And then you can pretend you're a sole proprietor. It's a very simple form of business. You don't have to file a separate tax return. You can use your Social Security or personal tax identification number if you want to. You don't have to get a separate tax ID number. I don't recommend that. I recommend you still get a separate tax number because you don't want your Social Security number out there, right? But nevertheless, if you wanted to, you could. All of the profits flow down to you as the owner, one person. All of that is reported on your individual tax return, so you don't have to do a separate corporate return or partnership tax return, which, you know, that adds, you got to pay, if you don't know how to do it yourself, you got to pay a tax preparer or CPA to do it. You're looking at $750,000 a year to file a tax return, where you can still, with a single member LLC, you can file it on your individual return. So that's what I mean by a sole proprietorship model. It's really simple. If you're going to do business and you'd otherwise be a sole proprietor, set up a single member LLC. It's really easy to do. There's not a lot of expense ongoing for administrative costs. Gives you that liability protection. And it's just really a really nice, easy way for one person to do a business. You can have employees and everything else, but it's just you as the owner. So that's the sole proprietorship model. The advantage over sole proprietorship, limited liability. Advantage over a corporate model, you don't have to file a tax return like a corporation does. So there's advantages to it. All right, the general partnership model. Now again, the advantage of a general partnership is all of the partners get a vote. So they have management authority. They all get a vote on things. But of course the disadvantage is unlimited liability for all the partners. So you don't want that. So as an LLC, you can set up and have everybody have a vote based upon your percentage ownership. And this is called a member managed LLC. And this is percentage vote. Okay? So you got more than one member. So 4 siblings that inherited the farm. They don't want to be a C Corp. Don't necessarily want to be an S Corp. So they be a member managed LLC. Each of them get 1 vote out of 4, so majority rules. And the idea is they all get to have management and voting, but don't have unlimited liability. The LLC provides them the same liability protection basically as a corporation. Very, very common. I'm seeing those instead of pretty much any kind of partnership now, because everybody gets a chance to vote, you all get input, you have liability protection, you don't have this limited partnership role versus manager role. Works out really well. So these are the most common two that we see in everyday life. Then we have the limited partnership model. Now remember, limited partnerships is where you have a manager and you have investors. Problem with limited partnership, the investors cannot engage in any kind of management. And the other problem is the manager has unlimited liability. All right, well, here comes an LLC. So we set this up as a manager managed, can't spell that, LLC, manager managed. So this is where, back to our apartment building, we have 3 of the LLC members that are going to be investors, but they will now have some voting authority. We're going to set it up so the investor can vote on, number 1, who is going to be the manager. Number 2, they get a vote on major decisions, and we'll outline them right in our LLC agreement. So anytime we're going to sell real estate or buy real estate, that requires a majority vote of all members, not just the manager. If they're going to refinance any loan held that's secured by real estate, so the mortgage, that has to be a vote by the owners. Any debt in excess of $5,000 or whatever number, all owners must vote on. Any credit cards, all owners must vote on. So you have the categories of things. Now day-to-day stuff, the manager is going to handle that. But big ticket items, everybody gets to vote. Can't do that in a limited partnership. You can do it in a corporation, but then you got corporate problems. So manager managed LLC is the model where you got the manager that's in charge, like an apartment building, but the investors still get to engage in management. Not super common, but very common nonetheless. Yeah, question?
So the manager is now, he doesn't have limited liability, he has limited liability.
No, the manager now has limited liability.
Okay.
Right, thank you.
Okay.
Yeah, I forgot to say that. So that's the other advantage over a limited partnership model. Everybody has liability protection. Everybody can vote, with certain exceptions. Now, one of the reasons you set up this manager manages, family farm. Once again, 4 siblings. I have this case right now, in fact, not a case, situation. 4 siblings, 3 of them live out of state. They don't want to have anything to do with the farm other than once a year they come out and they have like a family reunion kind of thing. And occasionally somebody will come out and go hunting or whatever. But the one sibling is actually going to farm it. So that one sibling is going to be the farmer. They're going to pay him a wage, and then they also get a percentage of whatever's left over. They split. Now they all have limited liability. The one that's actually doing the farming and whatnot is going to make more, of course, because they're the ones doing the work. But that way they can keep that family farm, in the family. And then it's structured that way going on to generations. So the way that one's structured is kind of interesting. I wrote this one up. Each sibling has 1 vote. And then over the generations, that's going to be each family of that sibling, that family member, family tree is only going to have 1 vote. And each sibling's family has to appoint somebody to do that vote. And that's going to go on for hopefully generations. So there's always only going to be 4 votes. And then each family's going to decide who's going to vote for. Yeah. So far that's worked out really well. And then finally the corporate model, and that's where you have the board of directors, CEO, president, vice president, on down the line. And then there you have 2 variations. I'm really going to throw you guys for a loop. So you have the corporate model of an LLC. And you can even issue shares, just like you would in a stock, shares of stock in the LLC. But unlike an S-Corp, you can have any kind of owner you want. It doesn't have to be a human. You can have more than 1 class of ownership. So you can have Class A, Class B, preferred, voting, non-voting, convertible, just like you could in a C Corp. You can also do what's called a corporate election. So you're still an LLC, but it's called an S Corp election, where you can say, we're an LLC, but we want to be treated as an S corporation for tax purposes. And the reason why you do that is there's some savings in Social Security tax. Or if you wanted to, you could be treated as a C corporation, but you're an LLC. So you're an LLC, but you're going to pretend you're a C Corp. Now, the downside of that is you pay corporate tax. But the reason why you do that is if you want to hold money back, we talked about this before as a retained earning. You want to hold money back and not distribute that cash out every year to everybody. So you can hold back maybe to buy more properties, like rental properties, or research and development, or mergers, you're going to take over other companies. So you can hold that money back, not distribute it, and that way the owners won't get taxed on it, because they didn't actually receive the money. That's pretty rare, but theoretically you could do that. And the advantages with the LLC is you don't have as much formality as you do with a full-blown C Corp. So this is my own, I will just tell you my own take on how LLCs can be arranged. But this is what I see in the real world in my practice. So that's what I mean by an LLC is like clay. You can kind of form it into whatever you want it to be. Now here's an even crazier thing, is you may potentially have the ability to change from one form to another each year. So if you wanted one year to be a corporate form and then convert to a general partnership form, I don't know why you would do that, but there's probably some reason, just can't think of it. But theoretically you could change every year if you wanted to, kind of like a shapeshifter, right? What do they call it, doppelganger? Something like that. You know what doppelganger means? It's German for double face, or two-face, yeah. So that's where LLCs are super, super flexible. Now, problem. Twofold. Number one, initially this was a huge problem. The IRS had no idea what to do with LLCs. They originally were going to say, we're going to tax every LLC as a C Corp. In other words, you got to pay double tax, got to file a separate tax return. Eventually they kind of got it figured out, and they're like, okay, well, it depends how you're structured. So now if you're a sole proprietor, form a single member, you just do like you would a sole proprietor. If you're one of these forms, you file a Form 1065, which is a partnership tax return. If you're going to be an S Corp model, you file a 1120S form, which is S Corporation tax return. C Corp, you file an 1120 form, which is a C Corp. So they got that figured out now. That took about 20 years. The other problem with having it so flexible is if you don't have a really well-defined written operating agreement, it can lead to complete chaos because nobody knows who has the power to do anything. We don't know if somebody is the manager or not. We don't know what authority the manager has. That's where it all needs to be really well detailed in that agreement. Banks, if you're all, if you're not sure exactly what you are, they're not going to even open a checking account for you because they don't want to, we don't know who's going to be on the corporate account or the LLC account or whatever. So because of the flexibility, that can also lead to problems. It could be very advantageous, and for the most part it is, but it could also be a huge problem unless you're very well organized. Okay, I'm running out of breath, so let's be done for tonight, and we'll pick up with this next week. We'll get into some more different advanced type of agreements next week for business organizations, and we'll go from there.